So in December 22nd, President Trump passed, as we all know, the Tax Cut and Jobs Act. And it's quite a comprehensive document. All the facts have not rolled out from that yet. But it's going to impact all of us in our society. And it puts a pause sometimes on a buyer and a seller or an investor. And they're scratching their head saying, how's it going to impact what I want to do in my real estate goals? So we thought it would be great today to bring two experts. And I'm so glad people love doing taxes because it's not my favorite thing. But they love this. They have a passion for it. And they focus on real estate taxes. So we are delighted today to have Joanne Koontz and Marina Parkin here, and they're going to speak to you. You should have picked up a handout that they prepared for you today, and they're going to talk about this big job act and how it impacts everybody. They are going to be videoing this session today, and their purpose is to use it online for their marketing piece as well. So if any of you are up front and central, they will get releases for you. Please welcome them.
Thank you so much. Not only do we have a beautiful venue, but it seems that you've gotten up early and come all this way to hear about tax, which I think is pretty fantastic. So thank you, Jennifer, for having us. As she mentioned, I'm Joanne Koontz. I'm an attorney and CPA, and our offices are in downtown Sarasota. And this is Marina Parkin. She's my partner in the CPA firm, KoontzParkin. Our firm is an all-women specialty boutique where all we handle are real estate, business, and tax transactions. And of course, there's tax piece to real estate, there's a tax piece to business, there's a business to real estate, there's real estate in businesses. So this is all we do, and we do it, I think, fairly well. And what we try to do is handle all of this in a manner that makes it easy, less stressful, more profitable, less risky, all of that, so that whatever business our clients are in, they can go run their business and not worry about sort of all of this underbelly of legal and tax. So as Jennifer mentioned, with the new tax law change, there are several pieces that affect you in your real estate business and are going to affect your customers. Those changes are things that we want to let you know so that you can more efficiently run your business. You go to all sorts of seminars where you hear people say, here's how you work harder, here's how you work better, listing photography, social media, here are all the things you can do to do your business better. We think you're already doing a great job. We just like you to keep more of your money. That's always been an option, and now we'll find with the changes that it's even more significant and substantial, the changes that have come about that will allow you to enjoy substantial savings. Just by show of hands so that we can direct our conversation, who here has a PA or a PLLC already? Wow. Everyone else should be raising their hand as an individual. So I'm Joanne Koontz, Realtor. This is an exercise. You're at IMG, for God's sake. The least you can do is raise your hand, right? If you're not going out to the pro camp, at least raise your arm, my goodness sakes. So for those of you who are not already a PA or a PLLC, you're going to want to get your notebook out. For those of you who are, you're still going to want to hang with us because we've got more for you and we've got more for your customers. So I'll turn it over to Marina to kind of give us an overview of the changes.
Good morning. Before we get into some of the detailed items, I just wanted to give you guys kind of a broad overview. This is the biggest tax change since 1986. There's almost every part of the Tax Act is impacted with these changes. However, at this point, it's still very much of a rule dump. They've just released the document. There's very little guidance. There's very little direction. A lot of the things don't quite jive together yet, so there's going to be a lot more coming out. And it's our job to keep on top of all of this and keep reading. And as particularly at this time of year, as you guys are working on your 2017 tax returns, it's going to be important to see how your situation may be impacted with the 2018 changes. The good news is 90% of the people are expected to pay less tax under the new tax law, which is absolutely fantastic. and there's a lot of business breaks, and I think that's where that 90% comes from. However, the 10% of the people that are expected to pay more or about the same tax are going to be high-paid executives that live in high state income tax. So executives from New York or from California. So I think as you guys are possibly showing properties to these individuals, they're highly motivated to move down. And it's going to impact those particularly that may already be on the cusp of wanting to move. And some of these changes may just push them over the edge. And, we can get into a little bit more detail about that, but I think that's where you're going to expect a lot of the changes happening. IRS has released sort of a statement to say they're unprepared to answer any questions at this point relating to the new tax law. So don't call us, don't write to us. We have no idea what we're doing. That's what they're saying. So it's going to be up to you and your tax advisor to strategize and prepare a little bit for next year. The last thing I'm going to mention is most of the business changes are permanent. Most of the individual changes are only for 7 years. So as by the time we figure out how this really works, it may already be over if it's not extended. But for the next 7 years, there's going to be a lot of good things to take advantage of. So Joanna's going to go over some of the individual changes, and then we'll switch to some of the business changes.
So on the individual side, the mode, I guess, the theme of this tax act was supposed to be simplification. The tax code was supposed to get easier to use. Insert laugh here. Because the IRS doesn't even know how to use it, but we're charged with the duty of figuring this out. So one of the changes that was proposed was that we were going to move from 7 tax brackets down to 3. That failed. We're still at 7. The good news is each of the 7 brackets is lower. More importantly, the floor in which you enter the next bracket of income tax level is higher. So in the top tax bracket, for example, the old top tax rate was 39.6%. Now the top tax rate is 37%. More importantly, it's almost $100,000 difference from when you enter that top tax bracket. So the top bracket is 37, the second bracket's 35. That $100,000 that used to be at 39.6 is now at 35. So the jump is bigger than if you just go down the line and look at the brackets. Capital gains rates did stay the same, so that's good, especially from a real estate investment standpoint. Standard deduction was doubled, so for folks who don't yet own a home, their deduction for the standard deduction is doubled. However, personal exemptions were repealed. What does that mean? Kids, parents, anybody you could claim on your tax return, including yourself, personal exemption is gone. That was an area that was very subject to abuse, especially in lower socioeconomic areas. There were lots of black market selling of Social Security numbers for kids who couldn't be claimed for things like earned income tax credit. There was quite an abuse there, so that's why you see that change has come about. Estate tax for death tax and gift tax the exemptions have doubled to 11.2 million. So if you weren't wise enough to check out what George Steinbrenner did with no estate tax, you've got 7 years to be at 11.2 million in the off chance that that's of interest to you. Itemized deductions are going to be a good talking point for you with customers. When Marina mentioned that we're going to see our high income earners from high state income tax states getting caught in the crosshairs here, the reason is that the state and local tax deduction on Schedule A, where you itemize, is now limited to $10,000. That state and local tax includes real estate tax, income tax, and sales tax. So here we've been lucky. You could deduct your real estate taxes and your sales tax because we don't have an income tax. Very attractive. Our friends in New York, it's not hard for real estate taxes to be $30,000, plus they have state income tax, plus they have a local income tax, plus they have a sales tax. So now they're not spending any less, but their deduction just went from $30,000, $40,000, $50,000 down to $10,000. That is going to be the motivator that's going to push those who have the ability to say, I'm going to go ahead and make the jump and come to Florida If they were on the fence, this is a good shovel to help push. Another real estate related item individually is mortgage interest. Mortgage interest was deductible up to a $1 million mortgage balance. It's been reduced to $750,000. Keep in mind, for any of you who this might affect personally, if you had a $1 million balance on your mortgage and you've paid the principal down, you get a one-time free refi back up to $1 million, and that will still continue to be deductible. So if you borrowed, say, $1 million and you paid it down to $800,000, you can refi one time back up to $1 million, and you're going to continue to receive the deduction on that $1 million, not suffer that limit. Another mortgage interest item of note is home equity lines of credits, or HELOC. Interest is no longer deductible. But if you have folks who are looking to buy rental property, if they take a HELOC on their home, and we can trace the use of those funds back to the acquisition or improvement of rental property, of a business property, then that deductibility will follow that business property. So it will be deductible on Schedule E with that rental property if we can show that the source of the funds was used for that property. You take the HELOC and pay for college or go on vacation or pay off credit cards, not deductible. But if it goes into the property, it will be. So those are some things to just kind of keep in mind, talking points particularly with your customers. Alimony is going to no longer be included in income for the recipient, nor deductible for the person paying. So depending on which side of that fence you might land on, maybe some motivation for you. That was funny, come on. Is it that early, or was it not? I thought it was funny, maybe it wasn't. If you didn't like that, maybe you'll like this. Gambling losses have always been deductible. So if you lost money gambling, you could deduct it to the extent of your winnings, right? Now, not only can you deduct to the extent of your winnings, but now you get to deduct your travel to and from the casino.
Of course.
Don't all run to the casino. A few more practical items. The gain on the sale of a primary residence exclusion was on the chopping block. That was up for discussion during the proposed back and forth for the tax bill, and it ended up staying. So primary residence, 2 out of the last 5 years, the gain is excluded up to $500,000 for a married filing joint couple, $250,000 for a single person. Let's clean up some language while we're there. Does that mean homestead? No. One person says no. One person. Does that mean homestead? No. Why not? Homestead's a Florida thing. IRS has never heard the word homestead. Your principal residence had to be the place that was your primary home 2 out of the last 5 years. That means if you are selling or you're trying to get someone to list, this is something you should be mindful of. If they lived in the home a couple of years ago, then turned it into a rental, but are going to have a big gain, they need to sell before that 5-year window expires, or they get too far away. Their 2 years gets too far away to be still considered a primary residence. What I'm saying is you can't think of it as homestead because this could qualify a property that they no longer live in. It's the IRS. Of course, the rules don't make any sense. You can sell your primary residence that you don't even live in. It's beautiful. And you can continue to do it. So it's definitely a tool that you need to be mindful of. Not that you want to run out and dispense tax advice, but as you hear objections from folks, or if you hear them saying, well, I don't know, and maybe the market will keep going up, and I want to wait and see if I can get more, maybe you'll sell it for a little bit more, but if you give up that $500,000 gain exclusion, it's probably not going to net them more. So just something that you can use in your business to help kind of push people off of the fence. You don't have any fence setters, do you? No, I didn't think so. In terms of other individual items, we're going to get back to them after we talk about your real estate business. I'll let Marina talk a little bit about general business before we go into PAs and PLLCs.
Okay, sounds good. On the business changes, couple of major things I'm going to highlight. Depreciation. That's a fun one. Being able to write off new business equipment, business cars, improvements to the property, improvements to the rental. The rules have changed actually for the better, and you can now deduct almost all of the improvements, almost all of the business asset purchases right away in the year of purchase. So you don't have to set them up and write them off over time. There's of course limitations depending on the business, particularly when it comes to the cars. I know a lot of you have various ways that you deduct your car for business. Some use mileage, some deduct the actual cost. The mileage versus actual expense that analysis has not really changed, so we still need to see what's better for you. But in general, if you're buying a business property, write it off right away. In terms of the talking point to your customer, if you have somebody who's buying an investment property or a rental, before there used to be quite a few limitations on how much of the improvements can be deducted in the first year. Now with the new rules, you can deduct a lot of the actual big overhaul type of improvements to the rental property, including construction costs and stuff like that. So I think that's a good thing to talk about because that motivates these buyers to get a tax break. Moving on from the write-off of the business items, entertainment expenses are no longer deductible.
Oh.
No longer deductible.
So no fun for you.
No fun.
No fun.
Meals are still good at 50%. So if you're taking your people out, feed them. One of the planning points around that is if you're buying a set of tickets to take, your clients to an event, get into something like a corporate sponsorship where you give an amount to an organization and in return you get maybe a block of tickets. You can deduct that under corporate sponsorship, but the purchasing of the tickets and stuff like that is no longer deductible. Another thing is the club dues, membership dues. People want to be members of a club, yacht club, or what have you for entertainment purposes. That's always been a gray area, but now it's 100% not deductible. So there's going to be some planning points certainly around that, but that's something to keep in mind. Business losses. If you have a business loss from a different business or from your real estate business in the first year, you can no longer carry them back, but you can carry them forward and use against income in future years. And the carry forward period is indefinite. There used to be a limit, but now you can carry it forward until you can really use it up. With the carry forward, there's going to be some limitation where you have to look at your overall taxable income to see how much of the loss you can deduct. So there's a little bit of technicality there, but know that the losses are not lost there. 1031 exchanges are still good, and for real estate property only. So when you used to trade in cars, one for the other, that's no longer available under the tax law. You have to essentially sell a tangible property or a vehicle and buy another one. But as far as real estate property is concerned, 1031 is still good to go. And I guess the big thing that I want to mention, and that's going to be a little bit of the elephant in the room, and it's going to be the hardest thing to get our head around, and the biggest opportunity really for you guys to plan, is this 20% business income deduction. And I know some of you have heard it, and it's kind of a vague concept, but the idea is that when you have your business income and you have your gross revenue less all of the operating expenses, this new tax code gives you the ability to take 20% of that net business income and take a deduction of that 20%. So that's going to be fantastic, and that's going to give these small businesses a big break. Of course, there's phase outs and limitations and all sorts of things. The magic number there to watch is on your tax return, if you're married, filing joint, taxable income of $315,000. If you're under that, there's no limitation to that 20% deduction. If you're over that, there's some phase outs. For a single filer, it's half, it's $157,000 of taxable income that you have to watch for. So there's going to be some strategies on how to reduce the income so that you can still take advantage of the 20% business income deduction.
Does that apply to the Social Security tax that we pay on that income too, or is that just the income tax?
That's just the income tax.
Nice try though.
The other thing I should mention, particularly in this room, and that also affects those that make quite a bit and will see that $315,000 of taxable income on your joint returns. One of the things that are going to limit that deduction is if you're considered a specified service. And specified service is if you are essentially a professional. So if you're a lawyer, a doctor, a CPA, an insurance agent, a financial advisor, if you have an income over $315,000, that deduction is completely gone. Where the question is at this point is whether a realtor is considered a specified service income. We still have no idea. So again, that's the beauty of this new tax act. What they're trying to tie it into is having a license and having your business depend on your reputation. But that's still very general and very broad.
You guys are bad lawyers. You should not be saying this is us. You should be saying all the reasons this is not us, like the lobbyists are doing.
So there's arguments for it and there's arguments against it. However, just keep in mind that if your income is under $315,000, that does not apply, and you still get to deduct 20% of your net business income. Okay, so that's just $315 is going to be the magic number really to plan around. So now that I've scared everybody.
Speaking of magic, the only way to take advantage of that 20% is to have an entity which is eligible to be taxed as a pass-through entity like an S-Corporation. In English, what does that mean? I can't be Joanne Koontz Realtor. I have to be Joanne Koontz PA or Joanne Koontz PLLC because I first must have an entity to the state of Florida in order to tell IRS I want that S-Corporation election placed on top of my PLLC or my PA. It oftentimes confuses people because they're like, wait a minute, you just told me to be an LLC, now you're telling me to be an S-Corporation. An S-Corporation isn't a thing to be, it's a method of taxation. So first you have to build the garage you're going to live in, get the entity, state of Florida, LLC, PA. Oh, and then after, like dinner and dessert, afterwards, you then tell IRS, hey, take my PLLC or take my PA and tax it this way. Tax it as an S-Corporation. For those of you who've seen me speak before, I've been stumping on this for years to tell you you're going to save. The benefit of the S-Corporation tax status for you as a real estate professional is that you save 15.3% self-employment tax. So unless you're Warren Buffett and you feel compelled to contribute more to your community, you are otherwise voluntarily overpaying 15.3% of your tax. So I thought I sounded pretty good. Then the new tax law comes, so first you get to save 20% free. This is like tax Black Friday. 20% right off the top before you do anything, and then you still get 15.3% in self-employment tax. I need one good reason to not do this. Yes.
How does the subchapter S fit into that?
The subchapter S is just your communication with IRS to say, here's how I'd like to be taxed. If you jump on Sunbiz, anybody familiar with sunbiz.org? Sunbiz is our Secretary of State Division of Corporations website. This is where you would go to obtain your PLLC or your PA. That's where corporations are born, okay? In the state of Florida, they have no idea what you're talking about when you say S-Corporation, and you won't see it as a choice to select because it's not a thing to be. The term S-Corporation comes from subchapter S of the Internal Revenue Code, so it's an IRS thing. First, you have to have an entity at the state of Florida, your PLLC or your PA. Then you take that over to IRS and say, hey, I've got this entity, and now I have to tell you how I'd like it to be taxed. Because just like the state of Florida doesn't have a designation for S-Corporation, you'll find if you jump on the IRS's website, there's no designation for LLCs. You have to tell the IRS how you'd like that entity to be taxed. So in doing so, we make an election, Form 2553, where we tell IRS, hey, take my PLLC or my PA and tax it as an S-Corporation. The benefit is you get all of the savings. The downfall is, for those of my friends who are currently Joanne Koontz Realtor, you are reporting all of your income and expenses on Schedule C of your personal 1040 tax return. What do we like about that? It's easy. So you're already filing a return, it's just another schedule, we throw it on there. What do we not like? Really? It's plus 20%, plus 15.3% now. So it's the most expensive way to pay tax on your revenue from your real estate business. That's what we don't like about it. So it's cheap and easy, but it's really expensive, right? Sometimes people are concerned about adding administrative responsibilities. You should be tracking your business income and expenses anyways, even for Schedule C. So your homework really isn't any different. What's different is our job. We put all of the information on a different form. It is a completely separate tax return, so you are going to see that your cost of preparation is going to go up. But it's not going to go up anywhere near the amount that you're going to save. And that savings is annual. That's not a one-time savings. That's every single year. If you make $100,000, you guys are good at percentages, right? If you make $100,000 and you take 20% off the top and then you take another 15.3%, you're taking home a bunch more money. Questions?
It needs to be paid
about the PA, doing that, we're going to have a lot of agents that want to do it and should do it. Going to Sunbiz first and doing that's the first step, correct?
Going to Sunbiz is the first step. We have actually a resource for you if you would like to have the steps all listed out for you, because Sunbiz is that's where they start and stop, and that's the beginning, not the end of what you need to do. So yes, you're correct. First, there has to be an entity established. We have to, make that, yeah.
And it has to be in their own name. It can't be some fictitious name. Well, I get questions about that all the time.
Absolutely. So you have to be mindful of who you're working with. The folks, your business attorney or your CPA needs to be familiar with the FREC rules as well, because you've got IRS rules, you've got the state of Florida business rules, and you've got the FREC rules sitting on top of you. And certain things are permissible for general business that FREC's not going to allow you to do. For example, your name. It has to be Joanne Koontz, PLLC, or Joanne M. Koontz, PLLC, or Joanne Marie Koontz, PLLC. For my gentleman, if you say, well, I'm Joseph, but I go by Dave, you have to be Joseph. You can't be Joe, you can't be Dave. You have to have your PLLC be your legal name. Teams are a totally different story, and we'll avoid that for the moment. Also, for anyone who's operating as a broker, this doesn't apply to you. This is for the sales licensees. You could be a broker associate, but if you're serving as the broker, the PLLC is not the vehicle you want to take.
The other thing is, once agents do get their PA, or if that's the route they choose, they think that automatically they give it to me and say,
Magic
I want to
happens.
get paid like this.
Right.
Well, they have to change their license.
Correct.
Clean, and then
So-
they have to come to us.
Like I said, there's 10 steps, so let's talk about those. And let me first say, what's the difference between PA and PLLC? Any takers? So professional association, PA, is a corporation. For state law purposes, it's a corporation that requires you to have a license to do what you're doing. So you'll see law firms, accounting firms, engineering firms, seasoned agents who have been in the business for a long time, and a lot of times are PAs. PLLC is the LLC equivalent of PA. It's a professional limited liability company, and that PLLC is saying, I have a license to be able to do this job. Our firms are PLLCs. In terms of the difference, the protections are virtually identical. You're going to get the same liability protection in the off chance something happens, and Morgan & Morgan is for the other people, not you, right? In order to get that protection, we have to act like a business, so we have to observe some corporate formalities, we have to keep paperwork, we have to not commingle our bank accounts, all kinds of crazy things, right? Use the name of the business. And once you have that in place, you're going to get that liability protection. So the first thing is we have to create the company. We have to get a tax ID number or an EIN with IRS. We need to file Form RE16 with the Division of Business and Professional Regulation to move your license from Joanne Koontz to Joanne Koontz PLLC. You then need to notify your brokerage. We have to do a new W-9 and let the brokerage know, hey, this is the new licensee that needs to be paid. Although it feels like it's just you individually are no longer the licensee. What does that mean? Signs change, business cards change because the licensee changed. It seems little, just those few little letters, but they make a big difference. You need to update your your websites, you need to update your profile in Transaction Desk or whatever software you're using for your forms, because now the listing agent or the selling agent needs to be identified as the PLLC and not you individually. The S-Corporation tax election needs to be filed. You should have an operating agreement if you're concerned about Morgan & Morgan for the other people. You need a written consent to action to open your bank account. You need a separate bank account. You can say, well, I had a bank account already because I already kept my business expenses separate. That's great, but that business bank account is not tied to a business that doesn't exist. That means it's tied to your personal name and your personal social security number. And even if you beg the person at the bank to change it, I cannot tell you how many times that change does not go through accurately. And then guess who latches on if something happens? Our friends at Morgan & Morgan. Well, gee, you don't even have a business bank account. It's still got your social security number on it. So if you're going to do it, do all 10 steps. Don't do 2. Don't do 4 because you make a bigger mess and that's worse to clean up. So from that standpoint, we want to make sure we hit all of the steps. We want to do everything that you need to do to dot your I's and cross your T's that are going to give you liability protection and the tax protection that you're looking for.
What was that resource you said that had the 10 steps?
If you email me, I will email you the form. Yes.
We make this designation now, any income we've earned previous to this year, is that personal or can we do all our income?
No, because of your licensing, your commission checks are paid to your social security number until such time that your license is moved. So what will happen is if you all run home this afternoon, because this is such a fantastic idea, and form this PLLC or PA, you will find that in this year, you will have 2 separate schedules to report your income. You'll have a Schedule C from January 1st through when you get your license back, which I will tell you is about 30 days. The state of Florida has taken about 2 days to turn around a new entity formation, and FREC is taking on average 21 days to process your RE16. You can FedEx your paperwork to Tallahassee to get it there sooner, but there's no expedite fee or any way to get through the pile more quickly so that it's your turn to be processed. Let me also say that what also doesn't work is going to your broker and saying, I know I just had this double-sided $4 million commission check coming, just hold it and don't pay me. You earned that check with your individual name, and therefore, no matter when the check is dispersed, that's going to be reported under your social security number and not included in the S-Corporation income. So the sooner the better is the answer there. Other questions? None. You do know I'm suspicious of that, correct? I mean, I like to think I did a good job, but if you do think of other questions or you do have concerns, you're welcome at all times to call our office. We're happy to be a resource for you. We live in the same community and we want to watch everyone become successful.
One question for you. You mentioned 20 to 30% of your income should be W-2. I've heard a lot of different numbers on that.
It's because there's no real number from IRS.
So I've heard
They won't.
as high as 70, 80.
No, then that's bad. That's bad advice.
And I've heard people that are doing like 0.
Zero is a good way to get an audit because the S-Corporation regulations say you're required to pay a reasonable compensation. Failing to do so, you will not be caught immediately. Nothing at the IRS is fast. I know, pick up your jaw off the floor and then you're shocked. So it may take a few years. That's the other place you have to watch because your friends will say, oh, I've been doing that for 10 years and I've never had a problem. You've just not been audited. It doesn't make it right. So 0 is definitely wrong. 80% is foolish.
And that's been one of the hot issues, actually, is the reasonable compensation.
25, 30 is about.
It's like an apple a day keeps the doctor away. 20 to 30% is your apple. Pay some self-employment tax and they'll keep moving. Question?
Well, I've always heard that if you make under 100,000, it doesn't really make any difference to do the LLC.
20% times 15% times under 100,000. Simple math. I mean, I would say I used to tell people when I was on this platform, you need to be at 50,000 of gross commission for this to make sense to outrun your cost of your next tax return. But now that you throw the 20% bonus onto this, I would say it's down to 30. If you're doing this remotely full time, you should be making 30,000. You could make 30 in one transaction. So I really can't think of one good reason to not do this at this point. I used to say 50, but not now with this 20%.
Do you know about what it costs to do that?
If we do the formation, we do everything soup to nuts, so you don't have to worry about your 10 steps. You just show up and save money, and we do it on a flat fee of $2,000. Other questions? Thank you so much for your time. We hope you enjoy the rest of your meeting.
Thank you.
I'll let you.